When it comes to annuities, it's so easy to get lost in the weeds. People get caught up in all the different contract details, but they often miss the single most important factor. And that one thing, it changes everything about your taxes, the rules, and your retirement. It all comes down to how you fund the annuity.
Okay, let's really dive into this, because this quote just hits the nail on the head. It's not about the company's name or some fancy feature in the contract. The most critical piece of the puzzle, the part that's going to determine your taxes, your rules, and your flexibility, is simply where the money comes from in the first place.
So here's the crucial point, and I really want this to sink in. You could have two people buy the exact same annuity product, but if one person uses money from their 401k and the other uses money from a savings account, they are going to have completely different experiences and tax outcomes in retirement. And that's exactly what we're going to break down right now.
All right, let's start with the basics and just define what these two terms even mean. I think a great way to think about it is like this. Imagine you have two identical cars. That's the annuity. But the type of fuel you put in each car, whether it's pre-tax dollars or after-tax dollars, that changes all the rules of the road for that vehicle.
And honestly, this is the entire distinction. It really is that simple. A qualified annuity, that's when you use pre-tax money from a retirement account. A non-qualified annuity, that's when you use after-tax money from your personal savings. That's it. Let's look at what that means in the real world.
So if you're rolling over money from a traditional IRA or an old 401k, maybe a TSP, you're creating a qualified annuity. Now, you probably see the Roth IRA on this list and are thinking, wait a second, and you're right too. It's kind of a special case. It's a qualified account, but it has this unique superpower that we're going to get to in just a moment.
On the flip side, if you're using cash from a bank account or money you got from selling some stock, maybe an inheritance, or the proceeds from selling a house, basically any money that's already in your hands that you've paid taxes on, you are funding what's called a non-qualified annuity.
Okay, now for the part everyone really cares about, the tax implications. This is where that simple difference in funding can have an absolutely massive impact on your retirement paycheck. We're talking about a difference that could save you thousands and thousands of dollars.
And this makes perfect sense when you stop and think about it, right? I mean, the money you put into that traditional 401k or IRA was pre-tax. You got a nice tax deduction on the way in. So the IRS is just patiently waiting to collect its share when that money finally comes out as income to you. Now this is where things get really interesting. Because inside the world of qualified annuities, there is one type that completely flips the script on taxes. It's a strategy a lot of people overlook, but honestly, it's one of the most effective ways to create tax-free income for the rest of your life. And here it is, the power of a Roth IRA annuity. See, even though it's technically a qualified plan, it was funded with money you already paid taxes on. And the result? Every single penny you withdraw, not just your principal, but all the growth too, is 100% tax-free. It's one of the only ways you can create a guaranteed, tax-free income stream for life, and it has no required minimum distributions.
So what about the non-qualified side? Well, with these annuities, you've already paid taxes on your initial investment, right? So you will never be taxed on that money again. It comes back to you as a tax-free return of your principal. You only pay ordinary income tax on the growth, on the interest you've earned.
Okay, so we've got the definitions down, we understand the tax rules, but how does this actually apply to your financial goals? Let's walk through a few common scenarios and see which type of annuity might be the best fit.
This chart kind of lays it all out. If you're looking at your 401k and you just want to turn it into a personal pension, well, a qualified annuity does exactly that. If you've already maxed out all your other retirement accounts, a non-qualified annuity lets you keep on saving with tax-deferred growth and no contribution limits. If leaving money to your family is a big deal, a non-qualified annuity is great because it doesn't have those required minimum distributions. And like we just saw for that 100% tax-free income, the Roth IRA annuity is truly in a class of its own.
So really, it all boils down to this one simple question. Your answer is the key that unlocks which path you should explore first. Are you working with the money you've already saved up in your retirement plans, or are you looking to put new after-tax savings to work for you?
Look, understanding this core difference is the first and honestly the most important step. But applying this knowledge to your unique financial picture, your goals, your accounts, your specific timeline, that's what creates a truly successful and stress-free retirement.
A generic answer just isn't going to cut it. We can help you compare all the options and show you the exact tax outcome of each choice before you ever make a commitment. To get your free, no-pressure plan, just visit us online at annuityexpertadvice.com or give us a call directly at 770-755-1565. We really look forward to helping you build your plan.